You know what's funny about the people who actually build serious wealth by 50? They don't look like they're doing anything impressive. In fact, if you watched their daily financial behavior, you'd probably think they were doing it wrong. They're the ones driving the 8-year-old Honda while their neighbors lease a new BMW every 36 months. They're the ones who still have a flip phone case on a 3-year-old iPhone, while everyone around them is pre-ordering the latest model on launch day. They're the ones whose coworkers genuinely wonder if they're struggling financially because nothing about their visible life signals wealth. And that's exactly the point. Because according to research from the Federal Reserve's Survey of Consumer Finances, the median American household between the ages of 45 and 54 has a net worth of roughly $247,000. That includes home equity. Strip that out, and most people approaching 50 have shockingly little liquid wealth to show for decades of earning. But there's a subset of people, and they're not all high earners, who arrive at 50 with $500,000, $800,000, over $1 million in investable assets. And when researchers study what separates them from everyone else, the answer isn't income. It's not inheritance. It's not some genius stock pick they made in 2014. It's habits. Specifically, habits that look absolutely ridiculous to outside observers. Stay with me because what I'm about to walk you through will probably make you uncomfortable. Not because the information is complicated, but because some of these habits feel socially humiliating to adopt. Your brain is going to resist several of them. And that resistance, that cringe you feel, is actually the clearest signal that the habit works. Because if it were easy and glamorous, everyone would do it, and it wouldn't create any advantage. Here are 7 money habits that look stupid but quietly build a fortune by 50. Habit 1. Deliberately keeping your housing costs embarrassingly low. This is the habit that draws the most social judgment, and it's the single biggest predictor of whether someone builds wealth over a 20 to 30 year period. Most financial advice tells you that you can afford a home up to 28% of your gross income. Banks will happily approve you for even more. And the cultural expectation is clear. As your income grows, your house should grow with it. Bigger kitchen, better neighborhood, extra bedroom you'll use as an office that's really just a room where Amazon packages accumulate. But people who build serious wealth by 50 do something that looks, frankly, embarrassing. They keep their housing costs at 15 to 20% of their gross income. Sometimes lower, they stay in the starter home. They rent when ownership doesn't make mathematical sense. They choose the smaller place in the less impressive zip code. And their friends think they can't afford better. Research from the National Bureau of Economic Research found that housing consumption is the single largest determinant of household savings rates across all income levels. Not because housing is inherently bad, but because of what economists call the consumption cascade. When you buy a bigger house, you buy bigger furniture. You fill more rooms. Your utility bills climb. Your property taxes increase. You need a lawn service, a bigger insurance policy, and suddenly your baseline cost of living has permanently inflated by thousands of dollars per month. A study from the University of Michigan tracking households over 25 years found that people who kept housing costs below 20% of income accumulated, on average, 3.2 times the net worth of people in the same income bracket who spent 30% or more on housing. 3.2 times. Not a marginal difference. A completely different financial life. And here's the psychology that makes this habit so hard to adopt. Housing is the most visible signal of financial status in American culture. It's the one thing everyone can see. Your car sits in the driveway of your house. Your kids go to school based on where your house is. When someone asks where you live, they're not asking for directions. They're calibrating your social position. So keeping your housing deliberately modest feels like broadcasting failure. Your brain's status monitoring system, which evolved to track your position within social hierarchies, screams that you're falling behind. But what's actually happening is you're redirecting thousands of dollars per month into assets that compound while everyone else is pouring money into a depreciating lifestyle. The house you don't upgrade becomes the portfolio that retires you early. It just doesn't photograph well. Habit 2. Aggressively overpaying boring debt instead of investing. Here's one that makes every finance bro on the internet lose their mind. Some of the best wealth builders prioritize paying off their mortgage early, even when the math says they should invest instead. The standard argument goes like this: your mortgage rate is 4%. The stock market averages 10%. Why would you pay off cheap debt when you could invest the difference and earn more? The spreadsheet says, invest. Case closed. Except behavioral economists at Yale found something the spreadsheet completely misses. People who pay off their mortgage early don't just free up cash flow, they fundamentally change their relationship with risk. And that changed relationship produces better financial outcomes over the following decades, even accounting for the theoretical lost returns. Here's why. When your house is paid off, your mandatory monthly expenses drop dramatically. And when your baseline costs are low, you can take career risks that higher earners with higher fixed costs simply can't. You can leave a toxic job. You can start a business. You can weather a layoff without panic selling investments at the worst possible time. Research from the Journal of Financial Planning found that households with paid-off mortgages were 4.7 times more likely to maintain their investment positions during market downturns compared to households still carrying mortgage debt. They didn't panic sell during 2008. They didn't liquidate during 2020. They held because they could afford to hold. Their fixed costs were so low that market volatility was uncomfortable but not existentially threatening. And that behavioral advantage, the ability to hold through the storm, is worth far more than the theoretical spread between mortgage rates and market returns. Because the math only works if you actually stay invested, and most people with high fixed costs don't. They sell at the bottom because they have to, not because they want to. So yeah, paying off your mortgage early looks mathematically suboptimal on paper. But in the real world, where humans panic and sell and lose sleep and make terrible decisions under financial pressure, it quietly creates a fortress of psychological stability that compounds into serious wealth. It looks stupid on a spreadsheet. It looks brilliant at 50. Habit 3. Refusing to upgrade things that still work. This one is genuinely painful to watch, and the people who do it know exactly how it looks. They're driving a car with 140,000 miles on it. Their laptop has a crack in the corner. Their winter coat is from 2017. Their phone case is yellowing, and every single item still functions perfectly. The psychology here runs directly against one of the most powerful forces in consumer behavior, what researchers at the Wharton School call functional obsolescence bias. This is your brain's tendency to perceive something as used up or done, not because it stopped working, but because a newer version exists. The moment a new iPhone launches, your current phone feels slower. The moment your neighbor gets a new car, yours feels older. Nothing about your item changed. Your perception of it changed because the reference point shifted. A 2021 study published in the Journal of Consumer Research found that people replace functional items an average of 2.3 years before those items actually fail. Not because they need to, because the existence of something newer makes the current thing feel inadequate. Now, run the math on that across every category. Your phone, your car, your laptop, your furniture, your wardrobe. If you're replacing things 2 years early across all those categories, you're spending tens of thousands of dollars over a decade on upgrades your life didn't actually require. People who build wealth by 50 have somehow short-circuited this bias. They've trained their brains to evaluate items based on function, not novelty. Does it work? Then it stays. And here's what makes this habit look stupid. It's visible. Everyone can see your old car, your scratched phone, your faded jacket, and in a culture where newness signals success, keeping old things signals the opposite. Your brain knows this. It feels the social cost every time someone notices. But here's what they can't see. The $400 a month you're not spending on a car payment quietly flowing into index funds. The $1,200 a year you're not spending on phone upgrades compounding at 7% for 20 years. The invisible portfolio growing behind the visible shabbiness. The habit looks like you can't afford new things. The reality is you can afford new things and you're choosing not to because you understand the difference between looking wealthy and being wealthy. Habit 4. Keeping a stupidly large cash reserve. Every investment advisor will tell you the same thing. Don't hold too much cash. Cash loses value to inflation. Put your money to work. Holding $40,000 in a savings account when the market is returning 10% is literally leaving money on the table, and they're right. Mathematically, But people who build serious wealth by 50 almost always carry what looks like an irrationally large cash reserve, not 3 months of expenses, more like 8 to 12 months. Sometimes more, and the reason isn't mathematical, it's behavioral. Research from the University of Colorado on financial decision-making found that households with larger emergency reserves made significantly better investment decisions during periods of market volatility. They held positions longer, they avoided panic selling, they continued investing during downturns when prices were low, and they took better career risks because they had runway. The oversized cash reserve isn't sitting there earning nothing. It's earning something far more valuable than interest. It's buying you psychological stability. It's the buffer between you and every expensive fear-based decision you'd otherwise make. Think about what happens without it. Your car breaks down, and suddenly, you're putting $3,000 on a credit card at 24% interest. You lose your job, and you're liquidating investments at the worst possible time. A medical bill shows up and your financial plan collapses because there was no margin for error. According to research from the Federal Reserve Bank of St. Louis, 40% of Americans can't cover a $400 emergency without borrowing. And when those emergencies hit, which they inevitably do, the cascading financial damage, credit card debt, penalty fees, lost investment positions, far exceeds what that cash reserve would have cost sitting in a high-yield savings account. People who build wealth by 50 understand something counterintuitive. The cash reserve doesn't need to earn optimal returns. It needs to prevent catastrophic decisions. And the decision it prevents, the panic sell, the high-interest debt spiral, the career move made from desperation instead of strategy, that decision avoided is worth 10 times whatever inflation ate from the cash pile. It looks like financial illiteracy. It functions like financial insurance. Habit 5. Saying no to social spending without offering alternatives. This is the habit that costs friendships. And the people who do it know it. They decline the group dinner at the expensive restaurant. They skip the bachelor party in Vegas. They don't split the $200 bar tab evenly when they had 2 drinks. And they don't pretend to have a conflict. They just say no, directly without offering an alternative plan that costs less. And it looks terrible. It looks cheap. It looks antisocial. But research from the American Psychological Association on social spending pressure found that the average American spends between $3,000 and $5,000 annually on social obligations they didn't actually want to participate in, not the events they loved, the ones they attended because saying no felt worse than spending the money. This is driven by what psychologists call the social default bias. When someone invites you to something, your brain treats acceptance as the default and rejection as an active choice requiring justification. Saying yes costs money. Saying no costs social capital. And your brain is wired to prioritize social capital because, evolutionarily, being excluded from the group was a survival threat. People who build wealth by 50 have learned to absorb the social discomfort of saying no without cushioning it. They don't say, "I can't make it, but let's do something cheaper instead." They just decline. Not because they're antisocial, because they've recognized that the alternative plan is just a delayed version of the same spending pressure. A longitudinal study from Northwestern University found that people who regularly declined expensive social events without guilt maintained friendships at the same rate as people who always said yes. The friendships that ended weren't real friendships. They were transactional social arrangements built around shared spending, not shared connection. And here's the uncomfortable truth. The people who judge you for declining an expensive dinner aren't evaluating your character. They're evaluating your willingness to subsidize their social preferences. When you stop subsidizing, you find out very quickly which relationships were built on genuine connection and which ones were built on co-consumption. It looks rude, it looks cheap, and it saves thousands of dollars per year that compounds into tens of thousands over a decade. By 50, the social discomfort you absorbed in your 30s has turned into a portfolio that buys you actual freedom, not dinner you didn't enjoy. Habit 6. Investing in the most boring assets available and never talking about it. While everyone at the office is discussing their options trades, their crypto positions, their friend who made $80,000 on some meme stock, the people who actually build wealth by 50 are doing something so boring it doesn't even qualify as a conversation topic. They're buying broad market index funds. Every month, same amount, same fund, no adjustments, no strategy shifts, no research rabbit holes, no checking the portfolio more than once a quarter. And when someone at a party asks what they invest in, they either change the subject or give an answer so bland that the conversation dies immediately. Just index funds. That's it. Nobody follows up, nobody asks which ones. Nobody wants the details because there's nothing exciting to discuss. This habit looks unintelligent. It looks like they haven't done their homework. It looks like they're financially unsophisticated. Everyday trader, every crypto enthusiast, every active stock picker assumes they're leaving massive returns on the table. But the data tells a completely different story. Research from S&P Dow Jones indices, tracked over 20 years, shows that more than 90% of actively managed funds underperform their benchmark index over a 20-year period. 90%. The professionals whose entire job is to beat the market can't do it consistently. And individuals trading on Robinhood and Reddit tips are doing far worse. A landmark study from Dalbar found that the average equity investor earned 3.6% annually over a 30-year period. The S&P 500 returned 10.6% over the same period. That gap, almost 7 percentage points annually, exists because of behavior. People chase performance, panic sell, time the market, and constantly switch strategies. The boring index fund investor who automates contributions and never touches the portfolio captures the full market return precisely because they're not doing anything clever. Their inaction is their edge. Their boredom is their strategy. By 50, the person who quietly bought index funds for 25 years without ever having an interesting investment story to tell at dinner has a portfolio that dwarfs the active trader who had incredible stories, but inconsistent returns. It looks lazy, it looks unsophisticated, and it outperforms almost everything else available to individual investors. Habit 7. Treating raises and bonuses like they don't exist. This is the habit that feels the most psychologically violent because it directly contradicts the reward system your brain has been trained on since childhood. You work hard, you get promoted, you get a raise, and your brain says, "Finally, I earned this. Time to upgrade my life. New car, better apartment, nicer restaurants." The lifestyle expansion feels deserved because it is deserved. You did earn it. But people who build serious wealth by 50 do something that looks genuinely unhinged. When they get a raise, they don't adjust their lifestyle. They adjust their automatic savings. The entire raise, sometimes every dollar of it, gets redirected into investments before it ever touches their spending account. They got a $6,000 annual raise, and their daily life looks exactly the same. Their friends wonder if the promotion even happened. Their lifestyle gives zero indication that their income changed. This directly combats what behavioral economists call the hedonic treadmill, the well-documented phenomenon where lifestyle upgrades produce temporary satisfaction that fades within months, resetting your happiness baseline back to where it started. You get the bigger apartment, you're thrilled for 8 weeks, and then it's just where you live. Research from Princeton's Woodrow Wilson School found that emotional well-being stops increasing at a household income of roughly $75,000, adjusted for inflation. Beyond that threshold, more spending doesn't produce more daily happiness, it just produces more expensive habits that are harder to maintain. So when someone earning $90,000 gets a raise to $100,000 and upgrades their lifestyle to match, they haven't become happier. They've just raised the floor of what it costs them to feel normal. And when that floor rises, so does the pressure. Losing income becomes more terrifying. Career flexibility shrinks. The golden handcuffs tighten. But when you bank the raise, something remarkable happens. Your cost of living stays anchored to a number you are already comfortable with. Every future raise accelerates your wealth building without increasing your financial vulnerability. And because your lifestyle expectations haven't inflated, a market downturn or job loss doesn't trigger the same level of panic. According to a study from Vanguard, tracking investor behavior over 30 years, households that consistently redirected income increases into investments Rather than spending accumulated roughly 4 times the wealth of households with identical incomes who allowed lifestyle inflation to track with earnings. 4 times. Same income, same time period. The only difference was what they did with the raises. It looks like self-punishment. It looks like you're refusing to enjoy the money you worked for. And it quietly builds a fortune that buys you something no raise ever could: the freedom to stop working before your body forces you to. So there they are, 7 habits that will make you look financially clueless, socially awkward, and mildly deranged to anyone observing from the outside. Keeping your housing embarrassingly modest, overpaying boring debt, refusing to upgrade things that work, holding too much cash, declining expensive social plans without apology, investing in the most boring assets alive, and pretending your raises never happened. None of these will get you compliments. None of them signal success. None of them make for interesting stories. They're invisible, unsexy, and socially costly in the short term. And that's exactly why they work. Because here's what the research consistently shows. Wealth isn't built by the habits everyone can see. It's built by the habits nobody notices: the car you didn't buy, the dinner you didn't attend, the raise you didn't spend, the investment you didn't touch, the house you didn't upgrade. Every one of those invisible non-events compounds silently in the background, while everyone around you is optimizing for appearances. By 50, the gap between people who optimized for looking wealthy and people who optimized for being wealthy is enormous. And it wasn't created by one big decision. It was created by thousands of small, boring, socially uncomfortable choices that nobody saw and nobody applauded. You're not going to get recognition for these habits. Nobody's going to congratulate you for driving the old car or skipping the group trip. Your brain is going to fight you on every single one because it evolved to prioritize social status and immediate reward. But your brain didn't evolve for compound interest. It didn't evolve for 25-year investment horizons. It didn't evolve for a world where the boring choice repeated 10,000 times creates generational wealth. You have to override the wiring, not with willpower, with systems. Automate the savings, remove the decisions, build the structure, and then let time do what time does. The people who arrive at 50 with a fortune didn't get there by being smarter or earning more. They got there by being willing to look stupid for 25 years while their money quietly did the work. And if you're willing to look stupid too, your 50-year-old self is going to be very, very grateful. If this shifted how you think about what building wealth actually looks like, drop a comment and tell me which habit you're adopting first. And if you want more content that tells you the truth about money instead of what sounds good, hit subscribe, because the habits that actually work are never the ones that get applause.